Folks, what you're going to learn today, the focus of today's information is going to be on controlling the principal payment. Because when you have a loan that carries interest, the one thing that you know for sure is that when you make a payment, some of that payment goes to principal. That's the amount of money that you borrowed. And some of the money, or a lot of the money you pay, goes to interest. You've got a principal payment and you've got an interest payment. But what I'm trying to tell you today is once you learn how to read an amortization schedule, you're going to learn how to control the principal payment. And by controlling the principal payment, you can set your loan up to be paid off cheaper and faster by controlling the principal payment. But I'm telling you, it's not what you think. So let's go ahead and get that on the screen. What I have here is a mortgage of $150,000 at 5.375 interest for 30 years. Look at this. The payment, principal and interest payment, is $839.96. This is how we buy houses. We look at the payment. We look at the interest rate. We see that, well, if I was renting, it would cost me like $1,200, $1,500, $2,000 a month. But if I can get my own house for $839 a month, why wouldn't I do that? And this is generally how people think and how it's sold. But because you move from being a renter into a home buyer, the information is not there to help us to construct the loan in such a way that it benefits us. Now, somebody looking at this interest rate would say, listen, it was just recently 2.93%. They'll look at this 5.75 and say, that is a ridiculous interest rate. That's hurting us. But let me show you the truth of the matter. Even though this is what we see what the bank is looking for on a $150,000 mortgage for 30 years. They're looking for $152,000 in interest. Now, on the face of it, that's not good. For a $150,000 loan, the bank wants me to pay $152,000 in interest. And once I'm all done over 30 years, I will have paid back a total of $302,385.60. That is total interest paid as a percentage of principal, 101.59%. 100% loan on a house? Who pays 100% interest? A lot of us. And we don't even realize that we're doing it. But when you have an interest rate that high, what we need to do is that if you know how to read this thing, do you know you can flip the script? You can turn this thing around so that it actually can benefit you in the long run because of controlling the principal payment. That's what we're talking about today, folks, because I've had people who have modified the loan, got put into a 40-year mortgage because of the modification to lower their payment. And because of that, they think they're in a bad situation. But by the time they call me, I'm going to show them how they can benefit from that 40-year loan. Because with the P.I.L.L method, we don't look at how much time you have. We only look at how much money you owe and how we can get that back to the bank in an efficient manner. Now, watch this. Watch this, folks. On the very first payment, we have $168.08 going to principal, $671.88 going to interest. Let me see if I can make that just a little bit bigger. There we go. It looks better now. Okay. So they say, look at only $168 out of my payment is going to the loan, and the bank was charging me $671 in interest. I want to show you what's going on here. So once we understand how to read it, you can turn this thing around. So when you pay $168 to the principal of $150,000, that leaves you a principal balance of $149,831.92. So the bank uses this number, the month end balance, to figure out how much interest we owe on the next line. Okay. Always look to the next line, no matter where you are. If you're on the month end balance, look to the next line to know what to do. So when we take a look at this, then because the high interest rate, look at this, the interest payment on line 2 is only a few cents less. Okay. We just took off 76 cents. That's it. 76 cents. So your interest cost on line 2 is still $671.12. And that 70 something cents was added to the principal payment over here, of making it $168.84 going to principal. But let's see what we can do to mitigate this. You know what to do here, folks. You can save at the same rate the bank is charging you. What does that mean? Let's say we make this payment in January. We made our January payment, and now we can see that our February principal payment is $168.84. But do you have to wait till February to give the bank that $106.84? Absolutely not. You can actually prepay that money. You can prepay any amount that you want, but I'm just choosing this amount because it makes it easy for our example. So $168.84. What if we decided to give that to the bank in January instead? Guess what happens? No, I can give that to the bank and no interest is paid out of that money. None, because we've already paid our interest in January. So all $168.84 goes to principal, and I'm paid down to line 2 in January, where we owe $149,663.08. We just eliminated one line from the amortization schedule. We just shortened our amortization schedule, or eliminated payment number 2 for only $168.84. Dang. Is that how it works? And now we are on line 3 for February. So for $168.84 paid early, we drop down to payment number 3. Payment number 2 has been canceled for $168, and the interest cost on that line, $671.12, has been canceled. You never have to pay that interest for $168. So if that's true, what if we paid our mortgage in January, made the first payment? Now that we know that we attack the loan with the principal payment, this is why it's so important to control the principal payment. $168, $169, and $170. We're taking the principal payment for line 2, 3, and 4. We're giving that on top of the regular mortgage payment in January. And we get rid of lines 2, 3, and 4 for a lot less money and save the interest cost on line 2, 3, and 4. And our mortgage payment now, February's payment, is now on line 5. Now, payment number 1 is touching payment number 5 for a lot less money. We've eliminated 3 mortgage payments for a lot less money and killed over $1,900 in interest we never have to pay.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.